Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
So this is a special episode of Trends with Benefits. I recently had the opportunity to moderate a webinar with Jan van Eck and Shawn Reynolds. Both have been on the podcast before, Shawn most recently. But this offered Van Eck's investment outlook and offered ideas for potential opportunities in the marketplace. And I thought that given all the different cross currents in the marketplace today and all the issues that we're dealing with, that podcast listeners might like to listen to this as well. Now, there are slides that go along with this discussion, and you can reach out to us at info@vaneck.com for those slides, or catch the actual replay at vaneck.com. So without further ado, here is what to buy and when. Welcome and good morning. Welcome to the special investment outlook and discussion of what to buy and when. I'm Ed Lopez, head of product management at Van Eck, and I'm joined today by our CEO, Jan van Eck, and Shawn Reynolds, portfolio manager and head of the global resources and environmental sustainability investment teams. Gentlemen, thanks for joining us this morning.
Thanks, Ed.
I think we're going to have a really insightful discussion today about current markets, our perspectives, and the potential opportunities that Van Eck sees. This is a live webinar, a live presentation, so we are taking questions. Feel free to send in questions as you have them, and we'll try to get those answered. There will be a few minutes of presentation from both gentlemen, but we will leave plenty of time for questions. So with that, how about we get started, guys?
All right, let's go.
All right. Jan, let's start with you for kind of a broad overview, if you will. First off, with everything going on in the marketplace, there's a lot of cross currents happening. How does one stay on top of all of that? How do you formulate the conclusions to your ideas and to your outlook?
Sure. First of all, let's admit that no one knows what the future is going to look like. It can be a constructive exercise to think through different scenarios. So that big caveat. The other thing I would say, by way of where are we coming from? Where am I coming from? Two things. First of all, Van Eck itself, sort of our core principles, is that the world is constantly changing, and that the financial markets will reflect the changes in the world. And then the structure of the financial markets themselves are also changing. So I take a sort of big macro view of the financial markets, and we do not anchor and don't think investors should anchor on some kind of 60-40 or fixed asset allocation because the world changes so much. I've started doing these outlooks several years ago. I take the input from my investment colleagues who I sit around behind me, the active investment team. And what we try to do is filter into some observations that maybe aren't being focused enough on in the headlines, in the newspapers, and in the thousands of charts that everyone sees in our industry. So just trying to focus on those with a historical perspective. You'll hear me say a couple of times today, over the last 100 years, or big structural change, a decade-long structural change. So
that's great. And so we've titled this presentation "What to Buy and When." I think it's a fairly provocative title. So let me just ask you, what's your outlook? What to buy and when?
Well, basically, I want to pound the table to buy bonds today. And then also say that a lot of developments that we're going to be looking at are going to not be clear for a period of time. So investors need patience. So that's the very, very short version. May be surprised to hear that from a firm with a lot of equities and commodities exposure, but I think bonds are super attractive right now.
Now, are you surprised at all by recent market action? In July, you said market volatility has one final act, and implying you were not surprised by recent market action. What did you mean and why?
Well, financial assets, stocks and bonds, typically do not perform well when the Fed is tightening monetary conditions. And the Fed announced at the end of last year that's what they were going to be doing, which included raising rates and changing their balance sheet actions. And they've been very clear in communicating that, and that's not a great time for financial assets. So that's really the short version. And if we do an update on that now, that's exactly what I see as continuing. So I sort of said, well, we're in the second act of a play, but I guess to extend that analogy, the third act could last a super long time. So maybe I'll walk through what I was looking at then and where we are at now. There's three things that are really in the face of investors right now, and it's three of the biggest things are all against financial asset investors. Number one, monetary policy is tight. Number two, fiscal policy is tightening and unlikely to be stimulative. And I'll exaggerate by saying we're in a global recession, certainly in a major global slowdown. So none of those things are good, and I don't see any of them changing anytime soon. Let me, first of all, talk about monetary policy. So what I'm looking at here is a chart of M2 supply. And what you see here is that the recent rate of growth of money supply, let's call this printing money, is close to 0%, which is the lowest it's been. It's typically kind of ranged between sort of low single digits. It exploded during the financial crisis. It went up a little bit. I shouldn't say exploded. And then during COVID, M2 absolutely exploded, orders of magnitude higher. But that's not where we're at right now. So annualized last year, it's 10% growth, and shorter term monetary growth is even tighter than that. But that's only one component, M2. What I focus on as well, that's the unknown that's happening in Q4 right in front of us here, is the Fed balance sheet. And what the Fed has said is that even though they were buying bonds right during the COVID pandemic, they are going to start effectively shrinking their balance sheet, or if you will, in a way, selling bonds into the market. And one analyst has that at $279 billion net coming through the end of this year. The Fed has only shrunk its balance sheet really once before. And so we really are facing a big unknown. And the way I describe it is, okay, a friend of yours is driving into a super dangerous neighborhood. I'm like, that's fine, go for it. I'd like to stay away from that. So we have this monetary tightening. Listen, you can argue all sides of this, but I see it as tightening, and there's still a major chapter here yet to go. So that's on the monetary side. And then on the fiscal side, so you can look at, if you look at wages, you have nominal wages going up. So it feels like the paycheck in your W-2 is going up, but because of inflation, your take-home pay has been negative over the last year. And we all know the gas prices and all the things that have been affecting the consumer. So I take away a lot of things from this. First of all, people are unhappy, right, because their incomes are down. And so I think you're likely to have a midterm effect where the Republicans take one or both houses. That is typical for midterms. If you have that, you're more likely to have gridlock. And also because, as Larry Summers pointed out, the stimulus spending during the pandemic led to inflation. You're unlikely to have a repeat, even if the Democrats control government like they do now. I don't see a big stimulative spending bill anytime future. So that's the big second effect of negativity on the financial markets, tight monetary and tight fiscal. I will say there's another point I'd like to make regarding wages, which is people talk about commodity prices a lot and the CPI and energy and gas. I think what the Fed is fighting is really wage inflation, because that is the kind of inflation that is endemic and very hard to get out of the system once it started, because the prototypical McDonald's worker wants to get paid more, the cost of the burger goes up, the workers that eat at McDonald's are paying more, so they want a wage increase, and it's a never-ending spiral. And I think that's why the Fed is being so tight. I think they know they can't control oil prices or the supply chain directly, but they really want this wage inflation psychology to be squeezed out. And it's very much present. And if you look at a chart of services inflation against goods inflation, so services theoretically doesn't reflect the price of commodities, right? You've seen services as inflation this year go up from about 3% to 6%. So that's not slowing down. And a lot of people aren't focusing on this fact, but services inflation going up, the Fed has to be fighting this battle. And I see that lasting for a period of time. So those are the setups, yeah.
Yeah, so I mean, you're saying, if I go back to a couple of slides, you showed money growth, which I assume we're saying perhaps led to a lot of inflation, but then we also saw that money growth drop off dramatically. Would one expect inflation to drop off just as quickly? Or are you now also basically just saying that wage growth is so strong, and then services inflation is so strong that despite that drop off and money supply growth, inflation could be persistent?
So we don't know. I love saying this in my outlooks about what you know and what you don't know. But last year, remember, a lot of people were talking about inflation. I kept pounding my fist on the table saying, we won't know about wage inflation until the second half of this year, which is frustrating when you're in 2021 waiting for 2022. But now we know. And I would say wage inflation is a thing. And the second factor that we have that's only happens a couple of times in 100 years, which is a pandemic. So what I point out here is we don't know how wage inflation is going to react, because the labor market is still tight in the United States, and we just don't know how workers are going to react, because a lot of people, change their behavior and their expectations. I mean, I was in an office building in Boston last week, and everyone was supposed to be in the office, and there were only about 10 or 20% of the people there. And so the back to work is part of this. They have the Great Resignation, and then the factoid that I read in the paper today that I love, is the fact that half of U.S. households are now supporting an adult child, meaning. So there are a lot of people that could work that aren't working now. Is it because America is a lot richer? Baby boomers have $71 trillion of wealth. Is it because of government support? We just don't know how the labor market's going to react. So, sorry, that's my diatribe. And I think it'll take a lot of pressure on the labor market, at least another 6 to 12 months before we kind of know, whether wage inflation is going to be endemic and what the Fed can decide to do.
And how do you figure global growth feeds into this story, into this narrative, and the potential for a recession next year?
So that's the big historical shift that is, item number 3 of bad news for financial markets investors. And I think what I'm showing here is just one factoid that I think is negative for global growth. So if you look over the last 20 years, oversimplifying the world economy, there have been 2 pistons of growth, the US and China. Everyone else basically didn't matter. China is now going to be at a much lower GDP growth rate for the next 10 or 20 years. I'm exaggerating and oversimplifying, but I think if we say China's growth is going to be 2%, that's a reasonable base case. So why do I say that? First of all, they have less pro-business government policies, number one. Number two, there's a decoupling happening, meaning we had this tariff fight, and it's less likely that there will be as much foreign investment into China as we've seen in the past. Third, their major engine of growth is the property market, and that can't be anymore a pillar of growth because they're going into major structural changes when it comes to the property market, Ed. And that's been well documented. But I'll give you a couple of factoids. About a third of property debt, according to Citibank, is in trouble, and Chinese banks are selling at cheaper prices than developed country banks did during the global financial crisis of 12 years ago. They're selling at half times book value. So there's something clearly that the markets is very worried about when it comes to property market and financing around that. And then the last point, which I think is structural and very, very reliable, is demographics. And what you can see here, very, I think, underappreciated fact, is that in 2100, China's population, which is over 1.3 billion now, is supposed to shrink to 800 million. So we've seen a peak in their workforce. We see their population getting older, and because of the one-child policy, this cannot change. So they are gone as a pillar of global growth. Gone. 2% growth in China is still significant because they're so wealthy, but still. So the baton of global growth needs to be transferred to Brazil, Indonesia, India, and you're just not going to probably see it at the same level. So when you look around the world today, Europe's in a recession, China's slowed down. It's a surprise to a lot of people, right? Coming into this year, everyone says, oh, China's just going to stimulate. Or like the happy version of that today is, once the COVID policy changes, it's back to the party. I think that's a scenario, but I don't think it's a base case scenario. So that's the third item. So for financial markets, and the main point, I think everyone could say, Jan, I know all that, tight monetary, tight fiscal, global recession, but is that all priced in? Is that going to change? It might change, but I think my point is it's going to be there for a while. And the thing that the markets are now looking at is what's the pressure on corporate profitability. Stocks are down because the PE ratios are down, but earnings are still flat. The question is, what are earnings going to be like over the next several quarters? And we don't know. But boy, have you seen, when a company said our margins are going to shrink or profitability is going to be affected, their stocks get pummeled. So that's the problem for equity investors. Is I think we have a lot of information to be gathered in October, January, and April as we get the next quarterly earnings.
We had just to kind of go back on one of your charts. We had a question that came in with regards to how the Fed is approaching their balance sheet. Do you see the Fed unloading their balance sheet with the sale of bonds, or just letting bonds mature?
Well, you get into a lot of Fed nuance, and frankly, there's a lot of Fed watchers who are more expert than me that talk about, well, you have to look at QT, letting bonds mature, and then what are their reserve ratio and repo liquidity function policies. I focus on something else that markets just don't like, which is uncertainty, and and the order of magnitude of shrinkage of their balance sheet. That's it. And if you look at the magnitude, it's greater than anything they've done before. And I would call $250 billion a lot of money, even in today's world economy. And I think just the unknown factor. Now, obviously, the Fed is focused on it, and I could give a bullish, and I'm bullish on bonds. So, but I just think that the Fed's not going to loosen monetary policy anytime soon.
I don't know if you can talk a little bit more about your bullish stance on bonds, but also curious about other asset classes where you might see opportunities or mispricings. If I remember right, a year ago, you correctly said that growth investments were overvalued. Those have come off. And you also said that commodity equities were cheap, and we saw those rally at the beginning of the year. What else are you looking at currently?
Maybe right before I get to that, let's just look at the punchline. So In putting this together, I said, boy, sure, if Jeremy Powell, the chairman of the Fed, is living in the 1970s, I vaguely remember the 1970s, what happened in the 1970s? And so it actually took a little while to get that data. The first thing I recall as a child, because my father started the first gold fund, is gold did phenomenally well. And so there was no conviction or confidence in the Fed, and gold, repped after being fixed against the US dollar for almost the entirety of US history. Gold and commodities did really well in the 70s. We know that. But what if the Fed, like it seems to have the market's confidence now, what happened? And what was super interesting to me when I took out gold and commodities from the 1970s is the best performing asset class was bonds. I said, wait a minute, that can't be right. The worst decade for bonds in the last 100 years of American history was the 1970s. How could bonds have beaten stocks? And that's what's giving me conviction in my punchline of today's outlook, which is when interest rates are super low, then an increase in rates can do a lot of damage to bonds. And that's what we've seen so far this year. This is the worst year for bonds since 1976. So we've been in this tremendous era of falling interest rates. But now that rates are up, and this is what you saw in the 70s, rates were going from 5 to 10% in the second half of the 70s. Bonds kept making money. And you're like, what? How? And the reason is an increase in interest rates from 5 to 6% is much less dramatic than the move from 1 to 2%. So that's number one. And number two is if you're getting paid a coupon of 6% or 7% and you reinvest that has a tremendous compounding effect. So this chart, and I know a lot of systems we use today don't go back to the 1970s, which is amazing in and of itself, right? But it's bonds that won, and so that's the the kind of insight. Now, sorry, long-winded answer to your question is there's been one. I don't see anything that's super cheap right now. I like commodity equities because of our in-house expertise. I know there's a great setup for supply and demand that no matter how fast the world is growing, there's a huge demand for renewables and the electrification of our grid. So that demand will be there and the supply isn't there. So that's why I'm bullish on commodity, especially those are tied to the energy transition. But we'll hear from Shawn in a second. The only structural change that I would point out over the last decade is rather dramatic, which is because of changes in regulation after the global financial crisis, banks play a very different role in our credit markets. And so what you can see from this chart is that in 2009, for every dollar in deposits a commercial bank took in, they lent that dollar. They're doing other things, so forget about leverage, but they were lending that dollar. 2 years ago, that got as low as for every dollar they had in deposits, they were only lending 60 cents. So basically a lot more of lending in America, to oversimplify it, happened outside of the balance sheets of commercial banks. Who was it? It was alternative credit hedge funds. It was business development corps. It was structured product that got sold off of the bank's balance sheets. So I guess, I'm pounding the table on bonds, but if you just look at spreads or any kind of bond indicator over the last 10 years, just remember that commercial banks are playing a much different role, and they also have a lot less liquidity to provide. So in sum, and then we'll bring Shawn into the conversation, monetary fiscal policy and global growth are all contractionary. A lot of things are cheap. So to answer your question, I don't see anything cheap in the stock markets in particular, or in the bond markets. Just lots of stuff are cheap. I do think commodity equities are particularly cheap, but I do think fixed income is very attractive right now. And I would save 25 cents in cash because if we do get a hiccup because of quantitative tightening, that can be a great buying opportunity, but you have to move super quick. And I would expect that in the Q4, but super quick, like you'd have to do it within days. I would expect. And then I think it'll take up to a year before you can start transitioning into more of an equity type of portfolio. So so there you have it.
That's great. And before we bring Shawn in, I ask you another point on the bonds view. Do you have a particular view of where in bonds? Are you looking at credit? Are you looking at long duration or short duration at this point, just kind of given where we are in the monetary cycle?
I don't think so. I talk to clients, they pound the table. I'm buying treasuries. I'm a hero, 2%, 2 years, I'm getting 4%. As I look at it, I don't see any particular breakage or anything cheap. I just think that, you can buy some individual bonds or converts of like a crypto company or something like that that's wicked cheap. But in general, I think it really depends on people's risk appetite, but I'd buy a little bit of everything.
Got it. Now let's bring in Shawn.
Shawn, just to add, because, and I know we'll get this question we talk about more, we don't know if we have a recession, how much damage is going to be done to some areas of the credit markets. Mm-hmm. But I would say a bunch of that is priced in. So I don't feel like I need to be a hero in deciding about recession and default rates. If I just buy a whole slug of, I don't need to hide in treasuries, I guess is my point, because you're getting some spread now in the high yield and other parts of the fixed income markets.
Great. Let's bring in Shawn. Shawn, one of the ways that Jan just ended off was talking about commodity equities being particularly cheap in a world that everything is cheap, but commodity equities in particular. Do you agree?
Yeah, I definitely agree. I think the outlook for commodity equities is pretty compelling right now. And, like most sectors in the space, they're getting really buffeted by the headwinds of rising rates and recession fears and all the things that Jan just talked about. But really, this whole conversation at this point, and most conversations about the economy really lead to you're talking about demand. And what's really supporting the resource sector right now is the other side of the equation, which is supply. And so we can't forget about that. And so, every day we see something that implies, tighter supply, from limited capital spending on projects around the world. We see, a slowdown in the drilling rig growth. We hear about copper supplies or production or new fields coming on stream at lower rates. We see shutdown of fertilizer plants in Europe, and now maybe even in Florida because of the hurricane. So there's lots of things really impacting supply, longer term, short term, lots of different reasons. But it all kind of sums up to the fact that I can't really remember another time in my career when there were so many factors impacting supply and limiting supply. And again, whether it's from capital discipline or the geology of the whole thing, i.e. every barrel, ton, ounce that we discover and produce today is harder to find, it's more expensive to find, it's usually less than we found last year, the year before, 10 years before. So, and then of course you have to worry about, wars and weather. We've always talked about that. Well, weather is a big thing right now. And then of course, obviously, the geopolitical issues that we're facing, really all suggest a much tighter supply situation. Now, as we sit here today, there are very temporal aspects of that, and there are structural aspects, and we can even think about seasonal aspects. We're in a shoulder season with regards to consumption of energy resources, and so you're getting kind of all this demand weakness piling up on a seasonal supply issue, and so you're seeing some weakness which might feed into the whole recessionary fears. But the reality is, I think as we kind of come out of this seasonal period, you're going to see demand just again due to weather and due to the seasons pick back up. and you're going to see that real tightness really tick in there. But the real icing on the cake when you talk about resource equities is the valuation. And yes, everything's cheap, but I don't think there's anything that's cheaper than natural resource equities. And I think we have a slide on that. And we look here in the upper left-hand corner, and you look at enterprise value to EBITDA for all the sectors in the S&P 1500 or 1200, and you can see that energy and materials, natural resources, are by far the cheapest. That's that little orange dot. It's enterprise value to EBITDA, by far cheaper than any sector in the rest of the market. They are, that little white line is 10-year median. So they're cheaper than their 10-year median as opposed to the rest of the market, which is none of it's cheaper. And then, in many cases, they're at their 10-year low, which is the size of that bar, as opposed to any other sector, which is nowhere close to its all-time low. Getting cheaper, I get that, and cheap relative to where they've been for quite some time. But it's hard to find something that's even cheaper than that. So we think the setup, the outlook for commodity equities looks very strong, and we can dive into some of these other issues in a second.
Maybe you could talk a little bit about supply, or the elasticity of supply. I mean, so we're going through some seasonal weakness right now. When things come back, I mean, how readily can the market, or these producers, add to supply? How long does it take?
Yeah, I think that's a real issue as well, is that across the spectrum with regards to resources, none of these commodities can come on stream real quickly. I mean, we got a little spoiled here in the United States, with the advent of shale, which we really thought, and we saw that we can respond in about a year. But when you really dive, down deeper, and shale is, it's still there, but it's coming to an end. Its heyday is over. So you're not going to be able to grow it, 1.5 to 2 million barrels a day. It's just not going to happen over a year's period. You're going to see some growth, but you're not going to see that kind of growth. But if you dive into metals and mining, I mean, things like that take years and years, even decades. The average time from discovery to on stream for a hard rock metal, be it nickel or copper or something like that, is 13 years. In fact, we had the CEO of First Quantum, one of the major copper producers, in our shop just last week, and and he used that term, 13 years, or that time frame, 13 years. And saying that, we're basically just not anywhere close to thinking about, going down that route of exploring that hard and starting greenfield projects. Prices are strong, but they're not strong enough to really incentivize that.
One of the other areas that I might be concerned about is where to look for commodity equities, or where along the production stream. I think in past cycles, when commodity prices did rise, you saw profit margins compress for some producers. How are firms approaching that? How do you approach that as an investor? Or how should investors think about that in terms of where, along the production stream that they might want to look?
That question comes up because during the super cycle from 2000 to 2010, you really saw cost ramp up. And although many of the companies, during that decade did very well, at the end of that decade, led to the 2010-2020 period, which is the lost decade, right? Where margins, shrunk and profitability shrunk, and you really saw, a lost decade in the commodity equity sector. But what you have to keep in mind is that during the super cycle, the philosophy was really growth at any cost. It was just grow with volumes. It was more production, more reserves, as much as we could find anywhere we can find it. And so cost really got out of hand. They took their eye off the ball, and so margins started to shrink down, returns started to shrink down, and that really was what really led to the 2010 to 2020 period, where you were oversupplied and you were just producing, again, barrels, tons, ounces that were unprofitable. Well, the other thing that to keep in mind, though, is that through that time period, 2010 to 2020, the sector really changed, and discipline is now the mantra. And so, it's really about not overspending, not growing, really focusing on returns, really focusing on cash flow. And when I say returns on capital and of capital. So huge dividends coming back to shareholders, special dividends, variable dividends, share buybacks, all coming back to shareholders. And what's really driving that is that discipline that managements today can remember back to the super cycle or 10 years ago and the lost decade and say, we're not going to live that life anymore, and so we're going to be much more conservative and think about, first and foremost, returns on capital. And then to the extent that we generate strong returns on capital and free cash flow, giving some of that back to shareholders. And really, really importantly, and lots of people say, yeah, well, that discipline can only last so long when you see, high prices like we've seen it, they're going to go back and blow it all. Well, the bottom line is, if you really have to look at what's incentivizing them, it's obviously their compensation. You look at executive compensation schemes, and that's completely changed. And really, thinking back to really 2000, 2020, most of those compensation schemes were based on growth. So it's growth in reserves, growth in production, whereas now it's growth or improvement on returns, generating free cash flow, and that's really what's going to, I think, drive the action of these companies. And I think another kind of ancillary part of that is that I think these executives are waking up and saying, wow, my life is a lot easier when I don't have to grow at some frenetic pace. It's much, much easier to grow at a moderate pace, really focus on operations, as opposed to, running, 30, 40, drilling rigs, or, trying to develop a mine on the top of, some mountain in Peru or something like that. It's much, much more sustainable to go forward the way we are. And by the way, I'm getting compensated that way. So I think that's how it's embedded and more structural than what we've ever seen really in my career.
So we've gotten a couple questions about some different sectors of opportunity, whether it's like lithium or uranium, but maybe I'll start out by asking you, what are your maybe like top 2 or 3 picks or favorite companies right now in the space, and why? And maybe that'll give us some insight.
Yeah, well, we can kind of get into that energy transition sector in a little bit, but one of our favorite companies right now is Equinor. It's a Norwegian energy company that traditionally produces oil and gas, but it's basically being supported by many of the market forces that I spoke about before. And most importantly, the most obvious thing is that the natural gas that they're producing and delivering to Europe is obviously very, very important. You see the Russian gas flows being restricted, and so Norway, and by association, therefore Equinor, is now the largest supporter or provider of natural gas into Europe. So they're definitely benefiting from the geopolitics right now, but it's also leading back to the discipline point. Cut its capex more than in half since the middle of last decade. It has a rock solid balance sheet and an incredible valuation. So right around 5 times PE and less than 2 enterprise value to EBITDA. So, incredible cheapness, and also a nice dividend yield. So we really like what's happening on the traditional kind of energy front at Equinor, but the other part of that is energy transition. It is a real leader in energy transition in the traditional energy space. So how does that manifest itself? They are one of the largest developers of offshore wind. So we hear about wind all the time, and we hear about some other large developers, but Equinor is certainly right in the middle of those major developers. They are the absolute leader in offshore floating wind, and that's a growing sector, and we definitely think that's going to grow and expand quite a bit over the next decade or so. They're also a clear leader in carbon capture and storage. So that's basically taking carbon from carbon emitting sources, some of direct air capture, and storing it underground. And they are undoubtedly developing the largest project in the world with regards to carbon storage. So ticks a lot of boxes there. And to us, it's really a typical, or prototypical energy transition story, because we really believe in energy transition.
And I think you had another name in there in the energy transition side of the ledger, didn't you?
There's lots of, what do you pick from? But, again, when we think about energy transition, we think about the whole spectrum. So we really, we firmly believe that you cannot decarbonize supply before you decarbonize demand. We've obviously gone down that route aggressively so far. So we look at, quote unquote, all of the above solutions, and and Equinor is one of those. But we also look at companies that are smack in the middle of new energy technology and forcing forward that transition. And so we try to be very disciplined ourselves, but when we think about technology risk, what we want is something that's going to basically disrupt the disruptor. So energy, transition is by almost definition, disruptive, but who are the leading technology players in that sector? And so, there's a couple of them that we really like. We really like names like Enphase, which makes the inverter. An inverter goes into every solar panel in the world. An inverter takes DC electricity and turns it into AC usable electricity. But the inverter actually turns out to be, kind of like the brains of the whole situation. It's more like directing where it goes from there. It can go, into your household, into a commercial facility, or it can go into a battery, it can go back into the grid. It really directs all of that. And so what Enphase is doing, not only is it a leader in terms of inverter manufacturing, it's kind of one or two in the world right now, it's also just continuing to move down that energy management technology, value chain of using batteries, using charging stations, using software to decide where should that electricity be directed. And so they've taken their wallet share potentially from $2,000 per household to $12,000 per household. So huge growth opportunities there. Obviously a gigantic addressable market, and they are the technological leader. There's another one that I really, sticking with the Norwegian theme, sorry about this, but we really like a company called Freyr Battery, and Freyr is based in Norway. It's global. It's actually got a gigafactory planned for here in the United States as well. And the gigafactory is a battery manufacturing facility just at world scale size. But basically, they are going to be a real leader in the battery world as far as we're concerned, because two things: they are pushing towards making the greenest battery in the world, and they're looking at the cheapest battery in the world. So you can see here that Freyr, it's hoping to produce at right around $60 per gigawatt hour, as opposed to your competitor, which is 120 plus. And then, as I said, greener. You can actually see that because in Norway in particular, they're going to be using hydropower and wind power to power their manufacturing facilities over there. They're going to be looking at a much lower carbon footprint than even a regular battery facility produces. So we're really like what they're doing there, and I just love the fact that they're kind of disrupting the disruptors.
That's great. A lot of great insight there on a few different companies. Want to give you guys both another couple minutes if you want to take it to offer any other closing thoughts before we open it up to questions. Shawn, was there anything else you wanted people to walk away from knowing today?
I just might leave with one kind of observation, or just ways to think about things. We went through, we called it a lost decade, 2010, 2020. But if you look at resource investing over 20 years, go back to 2000, and you look at that 20 years into 22 or whatever, resources in general have outperformed, even if they've kind of performed in line with the broader equity market. That's great, but they've actually outperformed. They've provided you, protection against inflation, leverage to growth, protection against weak growth, and then diversification. So it's kind of that, nirvana asset class that, Jan mentioned patience at, the very beginning of his, talk here is, you do have to have patience. But if you have patience if you think about, a 20-year and portfolio, 20-year plus, there's definitely a place in your portfolio for a decent sized resource allocation if you have that patience.
Excellent. Jan, how about you? Any final thoughts before we open to questions?
No, bring on the questions.
All right, let's see what we got here. One question we have is about preferreds, but that opens up a broader question for me with regards to, say, equity dividends or dividend equities relative to fixed income. Now, are they, on a relative basis, less attractive than fixed income?
I would say within the equity universe, and again, what's interesting is we don't have great data for the 1970s, but dividend paying stocks, I do think, get better rewarded in a market environment like this. So that's happened, and I would expect that to continue. But I'm still going to stick with my fixed income line, because I do think even if you're a stock at paying a 4% dividend, you still have to compete with bonds, and it's just such a different environment that we've been in for the last when a 4% dividend was competing against 2% in bonds, you were like, you don't even think about bonds, right? So that's just kind of my point. And so maybe I'm exaggerating a little bit, but yeah.
And regarding the Fed balance sheet, is there a risk that the Fed will be unable to shrink their balance sheet? And what are the ramifications of that?
Well, that's definitely the second highest scenario is there has to be some kind of Powell pivot, right? Whether it's triggered by illiquidity in the fixed income markets or recession, unacceptable recession, or unemployment. So then they'll go back to increasing M2 and not shrinking their balance sheet. It's pretty straightforward. So in that environment, it doesn't really solve all the world's problems, but I do think financial assets will rip because then the whole enterprise of the Fed having credibility will fail. And I think, again, I call it home office New York investors are too optimistic and looking for a Powell pivot, because I just think he's fighting the 1970s, and I won't repeat all the comments I made earlier, but I think it's very hard to fight the mentality of wage inflation. So I think that's what he's doing.
Any odds on a G20 nation defaulting on their sovereign debt?
Short answer: big financial risk in Europe. They did not rebuild the balance sheets of their banks at all. And U.S. regulators and legislators did force that onto the banking system. So U.S. banks are a lot more solid than European banks. And there's a lot of kind of interweaving between sovereign debt and commercial banks in Europe. So it's a big risk out there. That would be quite a disaster, I think.
Got it. And Shawn, we have a question about, let's see, the 4-week moving average for U.S. products supplied for middle distillates is down 16% year over year. Do you see this as a demand weakness or statistical wobble? I don't know what I just asked, but.
Well, as I said earlier, this is kind of shoulder season. So I think it's seasonal, and as well. But there is a serious shortage of diesel around the world. It looks like it might be amended a little bit by what's happening in China because of the things we talked about. Slowdown in China, you're starting to see big exports of product out of China that'll basically slowly make its way here. But you're also just seeing a slowdown, just as I said, seasonal.
Got it. And maybe both of you have an opinion on this. Is carbon trading, is that something that both retail investors and institutional clients look into? Do you guys have a view on that?
Well, I don't know, Shawn, I guess my question, did anything happen in the Inflation Reduction Act that would increase the chances of some kind of carbon trading regime expanding in the U.S.?
There was nothing directly towards carbon trading. There was some very expanded credits, which are called 45Q tax credits for carbon storage and usage, dramatic increases. So you're going to see more of that, which would lead more towards carbon trading. But I'll just say this, Ed, with regards to carbon trading, throughout the ESG world, there's no standardization. We've been moving towards that for many, many years. We're still not there. We're eventually going to get there. Way behind that in terms of standardization is carbon trading and carbon credits and defining carbon credits. And Van Eck knows about a fair amount about this because we own or have a position, or we own, I guess, the Van Eck family owns a redwood forest in California, which actually is the first forest project in the world that generated carbon credits that's used in the cap and trade system in California. So a carbon, we understand what's a quality carbon credit and what is kind of a make-believe carbon credit. And there's a lot of make-believe out there that's being traded around, and it's just not settled yet.
And maybe we could start to close it out. We've gotten a number of questions about a recession, and Jan, I think you said hard to really to tell, but one, the probability of a recession next year, but also the scope of it. Is it shallow? Is it going to be a deep recession? Again, perhaps maybe a quick summary of your view there.
I think my main point was, don't look at GDP growth for a recession. I don't care as an equity investor about GDP growth per se, right? What I care about is profits and the kind of what I'll pay for that profit stream. And I think in this case, we'll learn a lot from corporate earnings announcements, right? It's hard to sometimes imagine all the cost surprises that a company might face or demand, tail offs. A lot of businesses, not just Peloton, but there's a lot of businesses that are constantly changing. And so that's my point is, we'll have to look at that going forward, and we'll be learning a lot from, the next upcoming quarters.
Excellent. Well, I think that's the last of our questions, really. Any last thoughts before we end it?
No, thanks for the questions, by you, and we got a lot of participants, which is great. So always reach out to us online or through our Van Eck representatives. We've got a great website, and you can follow me on LinkedIn and Twitter.
Absolutely. And thank you everybody for tuning in. If you want a copy of today's deck, you can email info@vaneck.com for that copy. With that, thank you very much. Take care.